Alright, so welcome to lesson 2, the secret to achieving consistent forex trading profits. And notice I use the word consistent and not large trading profits because, would you rather achieve consistent profits month after month, year after year, or a huge windfall profit only to lose it all the next month and next year? I believe you want the first one, which is consistent profits. And very often you hear about people who make a lot of money in trading, right? They say, I made 1,000% return this month, or I made 100% return this day, or I made $10,000 and all that. Sounds exciting, sounds great, but what they don't tell you is most of the time they lose that same amount or more the next day or the next month. Most people can make money from the forex markets, but very few people can do it consistently, month after month, year after year. In fact, I always say that to make money in trading is very simple. Any idiot, any monkey can do it. It's called luck. Think about it. Everyday prices either go up or they go down. So if you place a bet on it going up or going down, you place a big enough bet, right? And if you happen to be at the right place at the right time, it's bound to go up or go down, right? So you've got a 50-50 chance of being right every time you place a trade. And there will definitely be people every day who happen to be on the right side, and that's the people who make a lot of money, get very excited, and they think it's so simple, so they bet more, and in the end of the day, they'll lose everything and a whole lot more. Why? Because when you depend on luck to trade, it doesn't last. Luck doesn't last. Luck happens from random events. So we do not want that. We want to make money consistently from the forex market like a business makes money. Not depending on luck, but depending on skill and depending on a strategy that's grounded on mathematics and statistics. So if you're with me, let me show you how this is done. So what is the secret to achieving consistent trading profits? I would dare to say that less than 1% of people who trade forex achieve consistent profits. So how do they do that? Are winning traders able to achieve consistent profits because they have the ability to predict the future more accurately? Most people think the answer is yes, and I can tell you the answer is no. Instead, the secret to winning traders is their ability to think differently from most other people. It's the ability to think statistically and to exploit statistical edges. Now, it sounds a bit complicated, but let me just explain what that means. First and foremost, you have to understand that stock prices, forex prices, anything in the market moves randomly in the short term, right? Price either goes up, goes down. It's 50-50, right? It's a random outcome. So to get a winning trade in the short term, it really depends a bit on random chance or luck. Okay, but again, to do it consistently, we can't depend on luck. So how do we assure consistent profits from random outcomes? Now, to explain this, let me use a metaphor. Let's imagine I have a game I want to play with you, and the game is about tossing a coin, right? So what happens is that when you want to play the game, you have to bet $1, okay? And I'll toss the coin. Now, if it comes out a hit, you will win $1.50. If it comes out the tail, you will lose your $1. So let me ask you this question. Is this a risky game? Would you play this game? Well, it depends, right? So if $1 is all you have in your life, you should not play this game, right? Because there's a 50% chance you're going to lose everything you have. So it's too risky, okay? Now, what if you had $100? If you had $100 and each time you bet $1, how many times can you bet? Right? You can bet 100 times, right? So let me ask you a question. If you play one game, your chance of being right is 50-50, right? But if you play 100 games, what is your chance of making money at the end of 100 games? Think of this question and kind of guess the answer. Right? I want you to think of the answer. What do you think it is? Right? Is it still 50-50? Is it less than 50-50? Is it more than 50-50? Oftentimes in my seminars, when I ask people this question, most people will say, hey, it's still 50-50. If I play the game 100 times, my chance of making money at the end of 100 games is still 50-50. Or some may even say it's less than 50-50. Well, the answer is this. If you play this game 100 times and bet $1 each time, your chance of making money is almost 100%. It's 99.9999%. Now, how is this so? Well, it's based on mathematics or probability theory. Now, if you've ever studied probability and statistics in school, you know that whenever you play a game of chance, you can calculate the expected profit per game or per toss. And the formula goes this way. It's a really important formula in trading. It goes percentage win multiplied by average win minus percentage loss multiplied by average loss. That's the formula that tells you if your expected profit is positive or negative. So let's use this formula. Now, what is your chance of being right or winning? 50%, right? Because it either is a head or tail if it's an unbiased coin, okay? So percentage win, 50%. Percentage loss, 50%. Got that? Now, what's your average win? In this game, your average win is $1.50, right? Your average loss is $1, right? Those are the game perimeter. So if you plug that into the formula, what do you get? You get 50% multiplied by 150 minus 50% multiplied by $1. Do the math, you get 25 cents. So what does that mean? That means that over many tosses, on average, each time you make a toss or you play a game, you're going to make 25 cents. So is this a positive result? Yes. So this tells you that this game has a positive expectancy to the player. There you go, positive expectancy. So what this means is that if you play this game 100 times, okay, you will get an average of $25 in total profit, right? So let me just draw this out for you so you understand. So your expected profit per toss or per game is 25 cents per game. So if you play 100 games, this means that statistically, you will make $25 in profit. Okay? So what I like you to do is this, and I'm serious about this. I like to grab a coin, okay? And in your free time now, if you have free time now, please do it. Grab a coin and toss it 100 times. Each time you get a heads, write down plus 1.5. You get a tail, write down minus 1. Okay? And get the entire result, add it all up, and see what you get at the end of 100 games. Okay? Now, will you definitely get $25? Of course not, right? But you get somewhere near $25. So you may get slightly more than 25. You may get 26, 28, $30. You may get $20, $19, $24, right? So it's random. But I can guarantee you 99.99% of the time, you will get a positive profit at the end of 100 games. So how's it possible? I mean, each game is a 50-50 chance of winning. Now, why is it over 100 games, you definitely make money? Because the secret is that the average win is more than the average loss. Okay? And that is the secret to achieving consistent profits from a game of random outcomes. Now, here's another way of looking at it. If you play 100 games, okay, it means that you get an average of 50 heads or 50 wins and 50 tails, right? 50 wins and 50 losses. Now, each time you lose $1. So you expect to lose $50 from the losing side, okay? And you expect to make $2, or rather you expect to make $1.50 for the 50 wins, okay? So 50 times 150 is $75. So 75 minus 50, you get $25. There you go. All right? So that's another way of looking at it. Now, let me ask you a question. If you toss a coin 10 times, will you definitely get 5 hits and 5 tails? No, of course not. Could you get 7 hits and 3 tails? Could you get 7 tails and 3 hits? Could you get 9 tails in a row? Yes, of course. So in a small number of tosses, the outcome is random. It's based on luck. But if you toss it 100 times, 200 times, 300 times, right, with a large sample size, it will eventually be 50-50 because that is the statistical probability of getting a hit. Make sense? So the same thing in trading, okay? Whenever you place a trade of 5 trades or 6 trades, the outcomes are pretty random. Sometimes you can get 6 winners in a row, right? You can say you're lucky, or you can get 6 losers in a row and say you're unlucky. So in a short term, it is luck that's involved in trading results. But if you trade 20 times, 50 times, 100 times, at the end of the day, you will always make money if your average win, in this case, is more than your average loss. And all you need to do is to be right just half the time. Now, what if you're right less than 50% of the time? Let's imagine that you toss 100 times and you get, say, 60 tails and 40 heads. What happens? Well, let's do the math. So that means you get 40 wins and you get 60 losses, right? So each time you lose $1. So that's minus 60 bucks. And each time you win $1.50. So 40 times 150, okay, is 60 bucks. So 60 minus 60 is break even, right? So this means that even in the event that you toss it 100 times and you get 60 losses and 40 wins, you still end up not losing money. You still end up breaking even, all right? But as long as you can be right just about half the time or slightly more than half the time, you'll make tremendous profits in this game. So how do we apply this to trading? So in this game, when we lose, we only lose $1, right? But in trading, can we predetermine how much we're going to lose when we're wrong? Yes, we can, and yes, we must. And we do that by placing a stop loss order the moment we enter a trade. So by placing a stop loss, we predetermine how much we will lose when we have a losing trade. And we must always calculate the size of our position in such a way that when we have a losing trade, we only lose a small percentage of our capital. And my suggestion is start with 1% risk. Okay? And when you've got a winning trade, you must win more than the risk amount. So if you risk 1% in a trade and you have a winning trade, you must make 1.5%. Make sense? Which is 1.5 times your risk. Now, if you risk 3% in a trade, which is the maximum you should risk, then when you're right, you should make 3 times 1.5. And 3 times 1.5 is 4.5% return. All right. Now, for those of you who may have gone through my stock trading course, you know in stock trading, I risk 1 to make 2. But in Forex, because Forex prices are a lot more volatile, I find that it's more optimal to risk 1 to make 1.5. It gives you much better results at the end of the day. Okay? So, if you make $25 on a $100 capital, which is $1 per game times 100 games, there's a 25% return on capital in 100 games, right? Now, the great thing about Forex is because it's a 24-hour market, so you can do a lot more trades in a given month. You can do 3 to 4 trades a day, if you will, and that's about 100 trades a month potentially. So how do we apply this principle to consistent profits in trading? All right, so in trading, remember, if you enter the market on a given day and you buy or sell randomly, right? You take a coin and toss it and it's a head you go long, it's a tail you go short, your chance of being right in the long run is going to be 50-50. Now, we do not want that. We want a better than 50-50 chance. We want an edge over random chance. So we get an edge by using technical analysis, which is what you're going to learn in the next few lessons. So using technical analysis, we're going to identify the trend of the market. So for example, when a market is on an uptrend, the probability of prices going up is higher than 50-50. It's not 100%, but it's more likely to go up. So when we trade with the trend, our chance of being right is going to be a lot more than 50%. Could be 60%, could be 70%. And this gives us an edge over the price direction. And we only choose high probability trades, which I'm going to teach you how to do, so that our win rate is going to be 50% or more. 55%, 60%, and on certain months, even 70%. Next, in trading, just like the coin toss game, we must fix the amount that we will lose by setting a stop loss. And again, we should only risk 1% of our capital to begin with. We can eventually graduate to 3%, but start off with 1%. Next, we must always set a predefined profit target. We must know exactly when we're going to get out to take our profits. And our profit must be at least 1.5 times our risk. Okay, so by risking 1%, like I mentioned, we must achieve 1.5% return in capital. And if you do this and stick to it, I guarantee your trading is going to have a positive expectancy. And once your trading has a positive expectancy, you have no fear about short-term losses, or you don't get greedy over short-term gains, because you know in the short run, anything can happen. But in the long run, you will always end up making money. And that's how we do it as professionals. So let me review what I just said and put it into what we call a trading business plan. All right. So if I'm going long on a currency pair, I will enter at a certain price, place my stop loss at a predefined level, and the distance from my entry price to my stop loss is known as the 1 hour distance, and R represents my risk, the risk I'm taking, right? And my profit target must be 1.5 R above the entry price. So I'm risking 1 hour to make 1.5 R. I'll have a positive expectancy, okay? Now, again, if I apply all the rules, right, I trade with the trend, I use the right candlestick patterns, I use the right strategies, will I win all the time? Of course not, it's impossible to win all the time, right? But we just have to be right 50% or more, okay? 50%, 60%, we're going to be right, and there will always be a 40 to 50% that it doesn't go the way we want, okay? And just by maintaining this and risking 1 to make 1.5 or 3 to make 4.5, that leads to consistent profits as a trader. Alright, so to implement this trading plan, we have to ensure that every time we place a trade, we place what we call a bracket order. And you learn this more in the lessons on placing orders. But basically, whenever we enter a trade, we must always enter with 3 orders at the same time: the entry, stop loss, and profit target. So the entry price is the price which we buy if we're going long, or we're selling if we're going short. The stop loss price, the price where our trade will exit with a loss, and we must always prepare for a loss in any given trade. Our take profit price is the price where we will exit the trade with a profit, and again, we must always plan to exit with a profit on any given trade as well. So in this case, if I'm going long, and I'm going long on the Euro USD at 3805, for example. Why? Because I expect the Euro to strengthen against the US dollar. So I will go long at 3805. So my entry price will be 3805. Okay? So before I activate my buy order, I have to place a stop loss, which will be a sell stop order at 3785, for example. Okay? And the difference from my entry price to my stop loss happens to be, in this case, 20 pips. So 20 pips is my stop loss distance, and that represents 1 hour, if you recall. So in this case, 1 hour is 20 pips. So my profit target has to be 1.5 hours. So 1.5 multiplied by 20 is 30 pips. All right? So I need a take profit order at 3805 plus 30, that's 3835. There's a sell limit order. So that's how I place my orders for a long position. Conversely, if I'm going short, I'll have my entry price, my stop loss, and my take profit as well. So let's imagine I'm going short on the Euro USD at, again, 3805, because this time I expect the Euro to weaken against the US dollar. So I'm going to go short at 3805, that's my entry price. So my stop loss in a short position is above the entry price, because when I'm shorting, I want it to go down. If it goes up, I'm losing money. I got to exit at a loss. So in this case, I place a buy stop order at 3825, which happens to be, again, 20 pips above the entry price. So again, my stop loss distance in this case is 20 pips. So 1 R is 20 pips. So my profit target has to be at least 1.5 R. So 1.5 multiplied by 20 is, again, 30 pips. So 3805 minus 30 pips is 3775. That's my buy limit order. Okay. So again, when we cover the lesson on placing orders, I'll go through more about understanding what's a stop order, what's a limit order. So if you're confused about those orders, no worries, we'll cover that in detail in the next lesson. on placing orders, right? Just for now, understand that when we place a trade, we always place an entry, a stop loss, and a profit target in this sequence. So if you do this consistently, let's take a look at the different outcomes, right? If you do an average of 20 trades a month, and that is pretty minimal by trading currencies, because again, it's a 24-hour market, I usually take an average of 2 trades a day. So that's about 40 trades a month. But say you take 20 trades a month. And let's say you get an average win rate of 60%. Again, you can't be right 100% of the time, but if you follow the trend, you follow the technical strategies, you'll be right about 60% of the time. About that, right? And let's imagine each time you place a trade, you're risking 1%, and you have a profit target, it'll give you 1.5 times that risk. So with a 60% win rate, in 20 trades, you expect 8 losses and 12 wins. Okay? Each time you lose 1%. So that's minus 8%. Each time you win 1.5%, that's 18%. So your net gain for the month is 10% return. Okay? That is based on a 1% risk per trade. Now, of course, if you risk 2% per trade, your return will double to 20%. If you risk 3%, triple to 30% return a month. Okay, so obviously the more you risk, the higher the returns a month, but the more volatility there'll be in your portfolio. Because when you get a loss, instead of losing 1%, you lose 3%. Okay, and at the end of the month, at the end of the year, you always make money. But understand this, okay? When you trade, you don't always get a win, a loss, a win, a win, a loss, a win, a loss, right? Sometimes the losses can come in a row. So you could get 5 losses in a row, and then you get 8 wins in a row, okay? And that affects many people's psychology, because the moment they get 5 losses in a row, they start to panic, they start to get emotional, and they start to abandon their strategy. When they start to get 6 wins in a row, 8 wins in a row, their head gets too big, they get too overconfident, they risk too much, and they increase their bet. You should never do that, right? So understand that you got to risk the same fixed percentage of your capital on any single trade, and let the probability and statistics and the edge play out in your favor over many trades. Now, what if you get a oops, we just did that. Okay. Now again, in this case, 60% win rate, but you're risking 3%, right? So like say eventually you get 3%, and your potential profit is 4.5%. So in this case, what happens? Again, at a 60% win rate, you are getting 12 wins and 8 losses. Each time you lose 3%, so that's 24%. Each time you win 4.5%, that's 54%. So the net result is 30% return amount, right? Which is what I just mentioned, okay? What if your win rate is just 50%? So there will be months where your win rate may drop to 50% or slightly less, and there will be months your win rate may go up to 70%, right? Because, you know, in a short run, it depends sometimes on the random luck of that month. 50% win rate means 10 losses and 10 wins. Again, if you risk 1%, that's a 10% loss, and 1.5% win per trade, that's 15%, so the net return is 5% per month for 50% win rate. Again, if you risk 2%, you get 10% return a month. If you risk 3%, it's 15% return a month. Okay, and I mentioned earlier on, there will be times where your win rate may go down to 40%. It just happens, okay? So again, you can use the best strategy in the world, and the strategy I'm going to teach you is one of the best in the world. You will have periods when the win rate may go below 50%. But counterbalancing to that, there'll be periods when the win rate will go up to 70%, right? So, but in the long run, it's between 50 to 60% win rate. So again, at 40% win rate, you're getting 8 wins and 12 losses. That's minus 12%, that's plus 12%. You're breaking even for the month. So all you gotta do is just be right more than 40% of the time, which is pretty simple if you follow the strategies in this course. Let's look at it mathematically. Again, let's go back to that formula we learned earlier on, which is our expected profit per trade, which is percentage win multiplied by average win minus percentage loss multiplied by average loss. So remember, every time you use a trading strategy, you got to use this formula to see, do you have a positive expectancy in your strategy? So in this case, if you have a starting capital of $10,000 and you decide to risk 1% of your capital, you're risking $100, right? And your average win would be 1.5 R, which means $150, because 1 R is 1% risk. So 1.5 R is 1.5% gain. So if you put this into the formula, what do you get? So let's assume you get a 55% win rate, which is between 50% to 60%, right? So at a 55% win rate, 55% of the time you're winning $150. 45% of the time you're losing $100. So if you do the math, that gives you $37.50 per trade. So is that positive? Yes, it is. So as long as it's a positive number, your trading strategy has a positive expectancy. So the trading systems I will teach you in this course all have a very high positive expectancy. So what this means is that if you do an average of 20 trades a month, statistically you should get $750 per month. Now $750 per month divided by $10,000 of capital, that's a 7.5% return a month. Again, that's based on a 1% risk per trade. If you risk 2%, your profit will be double, which will be $1,500, which will be 15% return a month. So once you are consistent, you can raise your risk per trade to 2% and finally to 3%. So to summarize, what makes a successful trader? To become a successful trader, there are 3 components you've got to have. And the first is you have to have, again, a trading system that has got an edge in the markets. And that is something that this course is going to give you, the trading system, right? Now, at the same time, you can have the best trading system, but you can still blow out your account. Because why? Even the best trading system with a 70% win rate or 60% win rate will go through periods where there may be a string of losing trades. So like I said, you could have 5 losses in a row, followed by 10 wins in a row. Now, what happens if you risk, say, 20% per trade, all right? And you happen to have 5 losses in a row, right? So each time you lose 20%, 5 losses, game over. You're out of the game. You've lost all your capital. And once you lose all your capital, you can't trade anymore. So we must always risk a small percentage of our capital so that in the event of a losing streak, which is inevitable in trading, it doesn't wipe out our capital. We have capital to stay in the game and keep trading until we make the money back and a lot more, right? So in other words, the second part of trading success, which accounts for 30%, is what I call position sizing. Knowing how to calculate the number of lots to trade in such a way that we keep our risk per trade consistent and small. Okay, so you're going to learn that under the lesson on position sizing. So 30 plus 10 is 40%. So again, you know what? You can teach 2 people the same trading system, the same position sizing rules, but they can both produce very different results. Because 60% of a trader's success comes from their psychology, their mindset, their ability to manage their emotions. And only when you can manage your emotions to overcome the usual fear and greed and hope and be able to trade logically and consistently will you produce optimal results. So what I mean by psychology, you must have the motivation to do the trades, the discipline to follow the rules, the focus to stick to the rules, and the determination that, hey, when things don't go your way, when you go through a losing streak, don't give up. Keep taking trades according to the strategy, and you'll always make money at the end of the day. Okay, so in this course, I'm going to focus not just on the trading system, which is really important, but position sizing and a lot on psychology as well. So please learn everything in this course in order to succeed in trading. Let me end off with this slide that summarizes, again, the 4 keys to successful trading. Number 1 is your entry setup, knowing exactly when to enter the trade. Number 2, when you exit the trade. This makes up your methodology or your strategy. The next is risk control, which is risking a small percentage of your capital. And finally, is having the trading psychology to consistently execute the trades without fear, greed, hesitation, or reservation. And that, my friend, is what will lead to consistent profits. So with that, that's lesson 2. I hope you enjoyed the lesson. I'll see you in lesson 3. This is Adam Koo signing off.